Hey everyone, Meet Kevin here. We've got to talk about my expectations for the stock market going forward because we just hit, I can't believe I'm going to say this phrase, a 52-week high. How remarkable is that? The NASDAQ 100 Technologies, I prefer ticker QQQM to measure it, just hit a 52-week high. That's absolutely remarkable given that it feels like we're still supposed to be in sort of a recessionary time, and you've got fears about Russia-Ukraine, even though they just extended a grain deal. You've got fears over the debt ceiling, even though we keep hearing they're not going to default. It's not over yet. We keep having talk about, well, there's got to be all this new inflation, while at the same time, corporations are missing earnings. Just unfortunately, almost seems like for the bears, the stock market recession may already be behind us, which is quite odd because a lot of people generally say, oh, it's when the Fed pivots, that's when we have the second true collapse of the stock market and we hit new lows. But I think for a moment, it makes sense to just zoom out and just ignore all the short-term data and noise, the corporate earnings, the short-term inflation expectations of consumers, which are so shaped by the media, the 5-year bond market's expectations of inflation, which are at a 1-year low, the Federal Reserve, the debt ceiling. Just put aside all of the noise for a second, and let's try to together logic out why would we be at a 52-week high on the NASDAQ, up 1.3% today at the time of this recording. Why? Does it make logical sense at all? Let's just start there and try to analyze that and then move on from there. Before we do, I have to quickly remind you, thank you for being here. If you like the kind of content I do and you want to see more of it, I know I haven't been posting as much lately, leave a comment. Let me know you want to see more videos. Subscribe. Consider sharing the video if you found this one helpful, or share a different video. It helps the channel out tremendously. Hit that like button. But I am considering flip-flopping again into some form of morning live stream routine, just mostly because as much as I like the idea of fewer videos that we spend more time editing, I get this like weird fulfillment of waking up early and just sharing my thoughts in the morning, and that is like missing. So anyway, let's get into this. Okay, this is the chart. Now I actually have the Fibonacci's drawn here on QQM, or QQQ rather than QQQM. Keep in mind that M is the cheaper version of this. It's exactly the same thing by the same company. M is if you are going to invest in this ETF, this index ETF, get QQQM instead of QQQ. You'll see it's the same thing, just a lower fee. So what do we have here? Well, this is basically a Fibonacci retracement drawn over the top of the market back in November of 2021. All the way down to the bottom of the market in October. And then you can see we've kind of started creating, if you could imagine that maybe in 10 years, this is the start of a volatile Nike swoosh, right? This is the thesis that I've had, that we're going to have this sort of rapid 1 year down, and then it might take a few years and we'll have this extended, longer, prolonged bull market. Hopefully, knock on wood. That's been my thesis, right? And if you look out, if you zoom out sort of onto the weekly chart, you could see the beginning of that, right? Picture that. There's your down, and then picture extending this for 5 years out, right? And obviously, if that's going to be the case, you'd want to be in rather than out. We don't know that that's going to be the case. But when we look at this now, we have to try to go back to October and think what was going on in the summer of last year, in September and October. What was going on? What was going on was we just had the double dip of inflation news. In other words, we thought maybe inflation would have been over in March. We got some bad reports and we got a soft report. And so the market rallied on that soft report. But as soon as there were signs that, we were actually about to get more bad reports, we plummeted. And we had the same thing happen a few times. It's been a very volatile way down on inflation reports. If you go back and look at the actual granular data, you'll see it. But you'll also have to align that in September, we got the Jackson Hole meeting where Jerome Powell essentially told us, look, we are going to have to go a lot higher. And it was really at that moment that markets internalized this fear of, oh my gosh, we could truly be facing a Paul Volcker moment. And that led to the tax loss harvesting leading into the end of the year because people thought, boy, let's get some more clarity going into the beginning of 2023. If we get Paul Volcker, which is a reference to 1981, 1982, the second double dip recession after the 79-80 recession, where essentially interest rates were jacked up from 8% to like 19%, more than a double, a 2.5x, just to control inflation expectations, that fear started getting priced into our market. And in my opinion, that is exactly why we hit a bottom. A true fear. Think about that for a moment. Why were we so low? A true fear that a Paul Volcker was coming. That we were going to get rug pulled and we were going to hell of a depression. In other words, if you go back to October, what did we have in front of us in October? We had, oh my God, inflation's not going down. We're going to get Paul Volckered. We are going to have a really nasty recession. Jerome Powell basically says we're screwed. Those were the fears that we had back then. Add on top of that commodities inflation, oil prices were still very high. China's reopening was going to create an inflationary boom. All this nonsense was ahead of us. Okay? Well, where do we stand today? Do we think we're going to get Paul Volckered? Well, no, because inflation is falling substantially. In fact, leading indicators at companies and earnings calls and that indicate that inflation is falling. Now, the debate has gone from, oh my gosh, inflation is out of control and we're going to get Paul Volckered, to the bear argument, which is, well, it's not 2% yet. And it's going to take a lot longer to get to 2%. So, therefore, it's bad. Fine. That may be true. In fact, if there's one lesson that I've learned over this cycle, it's patience. It's, things don't go as quick as you think. Now, patience aside, consider the difference of those arguments. The argument in October was, we have zero hope. Prices are still rising at substantial rates. Companies are still talking about rates going up. Commodities prices are high. Energy prices are high. That was right around the time of the Nord Stream pipeline. Oh my gosh, is the geopolitical situation going to go nuclear? Right? I mean, how many video titles did we see about nuclear warfare? So anyway, that was your October era. Today, it's like, wow, it's just not falling as fast as we'd like. That's okay, though. In a weird way, the Federal Reserve, and this is an important principle to remember, can undertake a principle known as opportunistic disinflation. They can do so as long as two conditions are met. So this is a lot of words. I'm going to try to simplify this. There are two conditions that the Fed needs in order to undertake opportunistic disinflation. Let me first explain opportunistic disinflation. Opportunistic disinflation is a fancy way of saying inflation is still higher than where we want it, but we don't have a rush to get it down, so let's just patiently wait for it to get down. This has historical context. In 1982, interest rates were 2.5x, inflation quickly fell to around 8 to 9%. And the Federal Reserve said, well, we eventually want to get to maybe 2.5%. How long are we going to take to get to 2.5%? Yes. In other words, they had no idea. They're just like, well, as long as inflation expectations are going down and those expectations are stable, we can be patient. Guess how patient they were? They waited 20 years to get inflation to 2%. 20 years to get inflation to 2%. They basically just used every next market cycle to ratchet inflation down. It was perfect. I shouldn't say it was perfect. Nothing's ever perfect. But the point is, as long as your inflation expectations are anchored, the Fed can undergo what's known as opportunistic disinflation. So, okay, well, that's also one of the conditions, is of the two conditions, inflation expectations remaining anchored. There are some worries that consumer expectations of inflation are de-anchoring because of the University of Michigan consumer sentiment surveys. However, there's an asterisk on that because consumer inflation expectations are really shaped by what news headlines are. And news headlines are blatantly lying to us, saying that companies raise prices 9% in the first quarter, when we know they raised prices 9% the first half of last year, which then when you look at a year-over-year comparison, you're like, no, the companies raised prices 9% year-over-year. Very different. Just ignore that for a moment. The point is, I think you could put on the tinfoil hat with me. I'll join you on this and say, the news media makes more money if they have more fearful headlines and articles. We all know this. Nobody can dispute that. And as a result, the news media would love for you to believe that inflation is still a massive problem. It's not. Fine. Is it at 2% yet? No, it's not. But again, we're going opportunistic disinflation here, right? Okay, so condition number one of opportunistic disinflation is anchored inflation expectations, which we have. 1 year low of the 5-year break-even inflation rate. Easy chart. Just Google that. St. Louis Fed, 5-year break-even. Boom, look at the chart, okay? Pay attention to it. If that disanchors, we got a problem. Then you have this idea of the Fed having a meaningfully restrictive position, policy position. Jerome Powell believes that is having a real rate at 2%, and you calculate that. Don't worry if I lose you here on this, okay? I'll just give you the bottom line. You can calculate what the real rate is by taking your outlook of inflation expectations and subtracting that from the Fed rate. If the Fed rate is 5% and 1 or 3 year inflation expectations are 3%, then the real yield is the difference, 2%. As long as we're at 2%, we're good. So what happens if inflation expectations fall to 2% for the next year out? Well, great, now we can bring the interest rate down 2%. Now, what if the Fed says, well, we actually don't need a real rate of 2%, we actually only need a real rate of 1%. Well, now you're at 3% Fed funds rate. So there are plenty of ways to loosen this. And I'm not trying to be permabull here. I'm just trying to say this is what the Fed is probably looking at. Well, as long as expectations are broadly in line, there's no rush to get this down. In fact, people are like, what do you mean, Kevin? They got to get it down, man. They got to get it down before they cut. No, they don't. They do not need to get inflation down. They just need to have inflation expectations anchored and the path of decline. They don't need to get inflation down by a certain point. In fact, take their own words for it. Let's just skip to that. Take their own words for it. Look at their last summary of economic projections. How long does it take to actually get inflation close to 2%? End of 2025. That's them, not me. They're basically saying, look, we know this is going to take a while. It's probably going to be 2 years before we get inflation down. And people are like, you mean they don't have to get inflation down to 2% sooner or before they cut? No, they don't. And so now, when we look at this chart of what I call the Nike swoosh, it makes sense. In fact, about a year ago at this time, I said, I believe this market is going to pre-price in the Fed's rate cuts well before they come, because we know the problem in this market is not the actual economy, it's inflation. Now, of course, we're starting to see faltering in the economy, right? Whether it's credit tightening or certain segments of the auto market or the freight market is in a straight recession, right? There are definitely problems within the market. But broadly, the economy is doing phenomenally well on a broad average. Again, that's not to say things aren't trending towards softening. But we look at S&P earnings, they're above 2019 levels. If you look at S&P margins, they've just declined to 2019 levels. This is like a normalization that we're going through right now. Can it get worse if the Fed goes too far? Absolutely. Don't get me wrong. If you're a bear and you're like, Kevin, man, you're full of it. You're biased. There are absolutely still reasons to be bearish. If inflation unanchors via the market's expectations of inflation, and these next inflation reports don't show us a continued, at least slow downtrend, we're going to have problems. The market's going to have to price in higher for even longer. And we're going to have to push back those rate cut expectations. Right now, we're looking at a 36% chance of a 25 basis point hike next cycle here, June 14th, and a 60% chance, well, a little bit more, like 64% chance of a pause. That has actually compressed. We used to be at 80% chance of pause. But at the same time as that is compressed, that is the odds of a pause have actually gone down, the stock market has actually gone up. In my opinion, that is solely because these two lower bounds of the Fibonacci retracement here, the two lower channels, are fear. They are fear that we are blatantly screwed worse than we were in the 1980s. Now, does that justify us getting to new all-time highs? Probably not, right? Then we really have to be on a path to 2% inflation. Then we can, absolutely. But again, I really believe in this Nike swoosh recovery. And I believe that the companies with the most pricing power are your NVIDIA, AMD, Intel to some extent, though it's the redheaded stepchild. You've got, Tesla. Enphase is probably at its bottom right now. And I think after AMD, NVIDIA, and these companies level out, which are big positions of mine, or I have personal exposure to them, then after they level out, I think that you're kind of like going to pull up like a rubber band, the left behind chip and innovative stocks, and those will be like the Enphase and the Teslas. I really don't think companies like Walmart. I mean, okay, this morning in the course member live stream, I had a hernia over Walmart. I kid you not. Okay, let me just give you a quick little example over why I was pissed at Walmart, okay? Walmart is a company that is trading at a 24.6 PE ratio with 3% revenue growth. 3% revenue growth at nearly a 25 PE ratio forward. That's dumb. On top of that, earnings per share are expected to grow 9%. That puts them at an almost 3 peg. Okay, they bring 1.1% to their bottom line. Costco brings 2.6% to the bottom line of everything they sell. Walmart barely makes money. Their valuation is stupid. And then, what's Walmart doing? They're paying dividends and issuing buybacks like total morons. Of their short-term liabilities and bills that they have to pay, they only have 11.2% in cash available. 5 times as bad as Costco. Costco has nearly 5 times as much cash available for their short-term liabilities as Walmart does. When you look at their long-term debt combined, you combine their long-term and short-term debts divided by the cash they have, Walmart has 13.7 times as much cash as debt. 13.7 times as much debt as cash. It's stupid. Walmart has about 2.7 times as much debt as cash. Costco. I keep screwing these things up. Costco's the better one. Costco has 2.7 times as much debt as cash compared to like the 13x of Walmart. But Walmart's doing well because people are still convinced, somehow confusingly convinced, that the best place to be going into a recession is defensive stocks. Oh, well, people still gotta buy toothpaste, so I'll buy staples like Walmart. Are you kidding me? At a 24 PE ratio, with earnings growth, like revenue growth 3% and earnings growth at 8 to 9%, this PEG ratio, Enphase is half the valuation. Tesla is like 60% of the valuation, like 60% less of a valuation than Walmart. What do you think is going to be worth more in 5 years? Don't worry, I already did the math. Our projection for Enphase in 5 years is around a 2.5x from here. Walmart, our projection for 5 years out, 4 or 5 years out, 28% up from here. What do you want, 2.5x or 28%? One's going to have more volatility than the other because Walmart thinks it's a great idea when you have that much debt and you're paying $500 million in interest in a quarter. They think it's a great idea to pay dividends and do stock buybacks. Whatever. That's just my personal opinion, right? Whatever. Those are the things we cover in our course member live streams, by the way. Things like that, along with real estate analysis. But so, what's the bottom line here? Well, I ask the people. I truly ask the bears. And it's okay to be bearish. I get it. You know, I was a bear at one point. January 2022. I didn't make every move perfectly. Nobody's perfect. It's okay. It's okay to make mistakes. But the point is, I ask the bears, what does it take to get back to this level? And they just say, oh, well, just wait, it's coming. There's going to be another drop, and it's going to be even worse than this because, you know, we're going to go into the real earnings recession or whatever. And then we look, and it's like earnings have normalized and margins have normalized to 2019. It's like, okay, so it's going to get even worse? Or, okay, maybe for the staples. You know, you look at chips, their earnings recession is over. You know, they had their 30% decline. So now you look and you say, okay, well, what is it going to take to get back there? Oh, well, a double dip of inflation. Okay, well, where is it? We're slowly trending down on inflation. Oh, yeah, but that's not fast enough, really? By what account does the Fed say we need to get inflation down to 2% now? They haven't even pulled the fate hat out of the bag yet. When they pull that fate hat out of the bag, we go moon. Because then it's going to remind the whole world that the Fed isn't trying to get to 2% at a moment. They're trying to get to an average of 2% over time. Flexible average inflation targeting. Look it up if you haven't heard about it yet. But beyond that, their own projection is we're going to wait until 2025. So look, this is my perspective. I do think we might be a little overextended here in the short term before the next inflation report. We'll probably have some red days before that. So like short term, doesn't matter. Long term, the Nike swoosh is here. I strongly believe in it. Thank you so much for watching this video. Really appreciate you. Hopefully we'll see you in the next video, and you know, once in a while, have some coffee out of a princess cup. See you in the next one. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced